Hey everyone, happy Tuesday. It's your girl, hashtag JLoan. That's right, it's Mortgage Tip Tuesday, another tip with your girl, your favorite girl. So, of course, I want to bring you what today's significant for, and how ironic that today's day's significant is today is National Florida Day, okay? It's the day that Florida was deemed the 27th state in the Union of the U.S. And if you know anything about Florida, it's also known as the Sunshine State. And now you guys know why I was always called Smiley, because I'm such a ray of sunshine. All right, I'm just kidding. I'm going to bring you your Mortgage Tip Tuesday, and this one is good. This one is really good because one thing you're getting ready to do is you are getting ready to file your tax returns. Now, if you're not getting ready to do a mortgage, then maybe this doesn't apply to you. But if you are getting ready to refinance, purchase, build, do anything that has to do with a home loan, I want to talk to you about some common mistakes or things that you can do on your tax returns that can help you, hurt you in the process. So don't make these mistakes, okay? So number one is claim your rental income. A lot of the times you want to use either to offset the mortgage, you want to use that rental income as income. And if you've owned a property for more than a year and you don't file it on your tax returns, you make it very difficult for you to use rental income even if you have a lease. All right, so I can make a whole video about this, but that just gives you the gist. Don't not claim your rental income. So please claim your, whether you own multiple homes or just one home, or maybe you're a new investor, you want to make sure that you claim your returns. Now, if you haven't owned the property for the whole year, then most times you're probably not required to, but to make it easier for you, again, just make sure you claim it on your returns if you want to use that for income moving forward on a home loan, okay? Ask your CPA. Oh, I forgot to preface this video that I am not a CPA. I do not give tax advice on how you should file your tax returns. Those are things you need to get from your CPA. I just want to let you know what happens on the mortgage side, okay? All right, moving on. So the next one is self-employed. Goes by what you tell the IRS you made. And this is the biggest thing that happens. Once you become self-employed, the only way that a lender knows how much money you make is by you filing your tax returns. So one, you have to file tax returns. Now, what they do go by is what you tell the IRS you made after all of your expenses. So keep in mind, if you grossed $150,000, but you told the IRS that you had $100,000 of expenses, then you paid taxes on $50,000. Well, now that is the income that we use to help you qualify for a home loan. So I'm not telling you how to claim your taxes, but just keep in mind that the more you tell the IRS you made, the more money you pay in taxes at the end of the year, but the more money we can use as income for you for your home purchase, okay? Now, there are people that work full time, but you have a side second job and you get a 1099 and you file this probably on your Schedule C on your tax returns. Now, just because you're W-2, that's great. That's stable income, hopefully. And then you have this 1099 and you schedule it on your, you claim it on your Schedule C, but then you show that you lost money by this second job. Well, of course, there are ways to work around this, but I have to give you what happens when you give us your tax returns. We see that loss, and that loss could count against your stable W-2 income. So again, if you do a side job, whether that's Uber, DoorDash, anything that you're doing on the side, and you claim that income on your tax returns, which naturally you should, but you claimed a loss, now we must count that loss against you. So be careful with that as well. Okay? Now, there is a deduction on your Schedule C that's called meals and entertainment. All right? It's a deduction that most people will write off if they're self-employed. But again, I can do a whole video about this, but whatever you put on that line, lenders double deduct that. So let's just say you claim that you made $50,000 at the end of the year, but you had $5,000 in meals and entertainment. Well, we double deduct that. So now your income is $45,000 a year. So be careful with that deduction because we do count that against you on a mortgage. All right. Now, number 5, claim your mileage. If you're self-employed and you're driving your own vehicles around, you should claim your mileage because we can use mileage and we can add it back in as income. There's no reason if you're self-employed that you should not be tracking your mileage and tracking all of the expenses that you have because we can add mileage back in. So don't forget to do that. Now, number 6 is something that happens that hurts because it says keep it all consistent. And the problem that we have is that you may file tax returns, but you label it different. So one year you'll say in 2019, I was a consultant. And then in 2020, you say I was a fitness trainer. But then you tell us, oh, they're the same job. Well, how do we know that? Because you labeled it consultant and then you said you were a fitness trainer. So if you don't want it to seem as if you just started being a fitness trainer, you need to make sure that you keep those names in line of what you do. So if you are truly a consultant, label it again consultant. So just make sure that you keep it very, very consistent. If you claim mileage one year, claim mileage the next year. Again, this is very important because self-employed borrowers to me have it the hardest when it comes to qualifying for a home loan. Okay? Now, the next one is depreciation can be added back in. This is a good line that your CPA can tell you whether you can claim something on that line. But if you do, you can actually add that back in. So if you had $10,000 of depreciation on there, after we calculate your income, we add that $10,000 back on there. So that is a good line to have on your Schedule C. Now, number 8 says, if you set up a payment arrangement on owed taxes, this monthly payment can count against your debt to income. So it's very important that if you owe the IRS, 1, the lender will see it. 2, they will ask you for proof that it has been paid. And 3, a lot of people think just because you owe the IRS money, you cannot get a home loan. And that is absolutely incorrect. You can get a home loan, but whatever payment arrangement that you set up for that to pay them back, we do need a copy of that. And depending on the term, we have to count that against your debt to income. So it's very important if you set a really high payment, it may knock you out of qualifying. So again, these are all things that you want to speak with your loan officer about. We're not CPAs, but we've dealt with this enough to give you mortgage advice when it comes to how you file your tax returns and what it can do to hinder you from getting a home loan. So most importantly, get a great CPA, speak to them about you wanting to get a mortgage or wanting to purchase or wanting to refinance, and they know that they need to help you and guide you in the best way to show the most income on your tax returns. I know CPAs are great at what they do, which is saving you money on your taxes. But when it comes to buying a home, all I can say is saving you money as a self-employed borrower and not paying the IRS for the income you truly made and writing off tons of expenses can hurt your chances. So I hope that this helps you while you do your tax returns. Remember, tax returns are a great way to add assets and use that for your home loan purchase. I love you all. See you next week. Have a fantastic week. Remember, be safe, wear your mask, and be blessed. Talk to you soon. Bye bye.